Welcome to the complete series recap for the Inventory and Cost Accounting Cycle, PNJ Group Cycle 4. Over 11 sections, you walk the full journey of inventory, from a purchase order all the way through cost of goods sold. In the next 20 minutes, we will tie it all together, phase by phase, so the whole picture clicks into place. Let us begin where every strong advisor begins, with the shape of the entire cycle. Here is what this recap pulls together. You will explain the 6 phases that carry inventory from procurement to reporting. You will apply job order, process, and activity-based costing to the right business. You will identify all 9 production variances and what they reveal. You will record the journal entries that make inventory the busiest asset on the books. And you will recognize the controls, red flags, and client cases that separate advisory work from bookkeeping. Let us start with the framework. Why start with the framework? Because inventory is usually the largest asset on a product company's balance sheet and the hardest to cost accurately. The cycle runs in 6 phases across 27 stages: procurement, costing setup, manufacturing, variance analysis, inventory control, and finally sales and reporting. Version 2 added the cost accounting backbone, system setup, and full variance analysis to what used to be a simpler flow. Keep this map in mind, because every concept ahead lives inside one of these 6 phases. Phase A is where inventory enters the building. Replenishment fires when the reorder point is hit, when the production plan demands materials, or when safety stock runs low. A purchase requisition, the PR, documents the need and must be approved before a purchase order, the PO, is raised. The PO is the legal contract, and no goods should arrive without one already in the system. Here is the key thing: get authorization right at the front, and every downstream cost is built on solid ground. When goods arrive, a 3-step check follows: quantity against the PO, quality against specification, and condition for transit damage. The goods receipt note, the GRN, is raised only for accepted quantities and uninspected stock waits in quarantine. For imports, customs clearance comes first, and the HS tariff code sets the duty rate. Here is a trap worth remembering: import duties are capitalizable into inventory, not expensed. Route them through an expense account, and you understate inventory and distort COGS timing. Landed cost is the total cost to bring inventory to its present location and condition, and it is the correct cost basis under a SC 330 and IAS 2. You capitalize purchase price net of discounts, import duties, inbound freight, in-transit insurance, and port handling. You do not capitalize storage after receipt, outbound freight, or abnormal losses. Divide total landed cost by units received, and you get the per unit cost that becomes either your standard material cost or your merchandise value. This number anchors everything that follows. Phase B sets up the cost accounting engine. The first decision is which costing system fits the production process. Job order costing suits unique, custom, or small batch work, where each job carries its own job cost sheet. Process costing suits continuous mass production, where costs accumulate by department and average over units. Activity-based costing, ABC, fits when overhead is large and products consume it in very different proportions. The system you pick becomes a documented accounting policy, applied consistently, so choose to match the process, not convenience. Standard costs are what costs should be under efficient conditions, and they anchor budgeting, variances, and valuation. Standard material cost flows from the bill of materials, the BOM, quantity per unit times standard price. Standard labor cost is standard hours times standard rate. The predetermined overhead rate, the POR, is budgeted overhead divided by a budgeted base, set before the period and applied all year. Capacity choice matters here. Most companies use practical capacity, because theoretical capacity creates large, misleading volume variances. When a company adopts ABC, it builds in 4 steps. First, identify the significant activities, things like setups, inspections, and materials handling. Second, group overhead into activity cost pools. Third, pick a cost driver for each pool, the factor with a real cause and effect linked to the cost. Fourth, calculate an activity rate and assign cost as rate times the product's driver consumption. The payoff is accuracy. A product needing frequent small batch setups finally bears the overhead it actually causes, instead of hiding behind volume. Standards must be reviewed and updated at least annually before the new production year. Skip this and variances grow meaningless because they measure the gap from an outdated benchmark rather than real performance. The annual update revisits material prices, labor rates, and efficiency, recalculates the POR, refreshes the BOM, and rebuilds the cost cards. The finance director and CFO approve before loading. Remember, a change in standard cost is a change in accounting estimate, applied prospectively, with disclosure if the impact is material. Phase C is where production happens and costs accumulate. A production order is raised from the approved BOM, specifying quantity, dates, and standard requirements. Raw materials are released against a material requisition note, the MRN, and the cost moves from raw materials into work in process, WIP, along the way you track mix when products blend several inputs, yield for output obtained from input, and scrap and rework. Excess requisitions above the BOM standard need supervisor approval and get flagged as usage variances. How WIP is tracked depends on the system. In job costing, the job cost sheet collects actual materials, labor, and applied overhead and transfers to finished goods at completion. In process costing, the challenge is partly finished units, so you express them as equivalent units of production before computing a cost per unit. Two methods exist. FIFO treats beginning WIP as a separate batch and gives a purer current period cost, while weighted average blends prior and current costs and is simpler to calculate. Direct labor is captured from time cards, and only time spent directly on production counts. Supervision and maintenance are overhead. Manufacturing overhead, MOH, follows a two-step path, assigned to cost pools, then applied to WIP using the POR or activity rates. Applied overhead is debited to WIP, while actual overhead hits a control account. At period end, the gap is the overhead variance. When actual is less than applied, overhead is over-applied and favorable. When actual exceeds applied, it is under-applied and unfavorable. Some processes yield several outputs from one input. Joint costs incurred before the split-off point are allocated to the joint products, most often by relative sales value, sometimes by net realizable value or physical output. Byproducts with minor value are usually netted against joint cost. Spoilage carries its own critical rule. Normal spoilage is expected and absorbed into good output, raising the per unit cost, while abnormal spoilage is a period expense. Capitalize abnormal spoilage by mistake, and you inflate both inventory and profit. Phase C closes with cost of goods manufactured, the COGM. The statement is beginning WIP plus total manufacturing cost minus ending WIP, where manufacturing cost is materials used plus direct labor plus applied overhead. Divide by units completed, and you get the per unit value carried into finished goods. One distinction matters for reporting. Full absorption costing, required under GAAP and IFRS, puts both fixed and variable overhead into inventory, while variable costing, used internally, expenses fixed overhead immediately. Absorption raises income when production exceeds sales. Phase D explains why actual cost differs from standard. Material variances split two ways. The material price variance compares actual price to standard price on quantity purchased, and it belongs to procurement. Think volume discounts or supplier changes. The material usage variance compares quantity used to the standard quantity allowed for actual output, and it belongs to production. Think waste or yield problems. When several inputs blend, mix and yield variances refine the picture, and together they equal the total usage variance. Labor variances work the same way. The labor rate variance, the LRV, measures whether the hourly rate paid matched standard, driven by worker skill mix, overtime, or wage changes, and shared by HR and supervision. The labor efficiency variance, the LEV, measures whether the team used the standard hours allowed for the output achieved, owned by production management. Idle time, when workers are paid but not producing, is a subset of efficiency and always unfavorable. Strip it out and you see true productivity. Overhead variances are the most complex because you split variable from fixed. Variable overhead has a spending variance, actual versus standard rate, and an efficiency variance tied to the allocation base. Fixed overhead has a spending variance, actual versus budgeted, and a volume variance, budgeted versus applied. That volume variance is unique to fixed cost. It arises only because fixed costs are applied at a predetermined rate on budgeted volume. It turns favorable when actual production exceeds budget, spreading fixed cost over more units. Not every variance deserves investigation, so companies set thresholds, often 5 to 10% of the standard element. Above threshold, you sort the cause into 4 buckets: measurement error, an outdated standard, random variation, or a real operating inefficiency. Reports go to the responsible manager, procurement for price, production for usage and efficiency. At period end, immaterial variances close entirely to COGS, while material ones are allocated across ending inventory, and COGS, so the balance sheet reflects actual cost, not just standard. Phase E protects the inventory you hold. Every physical movement, transfers, returns, consignment, must be matched by a same-day system transaction, and FIFO rotation is enforced at the picking face. A perpetual system updates records continuously, giving real-time balances and immediate visibility into shortages, which is why it is preferred for manufacturing. A periodic system only counts at period end and computes COGS as a residual, beginning inventory plus purchases minus ending inventory. Retailers can estimate interim values, but a physical count still verifies annually. Counting keeps the records honest. Cycle counting rotates a subset all year, with ABC analysis setting frequency. A items, the high-value top 20%, counted monthly, B items quarterly, C items annually. The key controls are independence and blind counting. Counters must not be the regular custodians and must not see the system quantity first. When physical differs from book beyond tolerance, you investigate timing differences, counting errors, and genuine shrinkage before any adjustment is posted, and you watch for patterns that signal theft. Inventory must never be carried above net realizable value, selling price less completion and selling costs. Lower of cost or net realizable value, LCNRV, is tested at every reporting date, not just year-end, and when NRV falls below cost you write down immediately. Under GAAP, that sets a new floor with no recovery. Under IFRS, an allowance permits reversal. The close then reconciles the inventory subledger to the general ledger, clears the GR/IR account, and accrues goods in transit. This is the primary detective control. Phase F turns inventory into results. Goods are picked, packed, and shipped with FIFO rotation and lot tracking, and inventory is relieved at confirmed shipment under perpetual. COGS is recognized in the same period as the related revenue, the matching principle. The costing method shapes the number. In inflation, FIFO gives lower COGS and higher ending inventory. Then gross margin analysis. Revenue minus COGS over revenue, by product and channel, becomes the primary bridge between cost accounting and business performance reporting. Inventory generates more journal entries than any other asset, 16 in this cycle, because every physical movement has a matching GL entry. The core chain flows logically: purchase at landed cost, raw materials issued to WIP, labor and overhead applied to WIP, completed goods transferred to finished goods at COGM, and finally COGS at the point of sale. Layered on top are the separate entries for variances, abnormal spoilage, write-downs, count shortages, and goods in transit. Master the chain and the rest follow. Controls span all 6 phases in 2 layers. Preventive controls stop problems before they happen. No PO without an approved PR. Standard costs approved by the finance director before the year. Blind counting by independent teams. Detective controls catch what slips through. Monthly variance reports. The subledger to GL reconciliation, GR/IR aging, and gross margin review. Underneath sits segregation of duties. Physical custody must never equal record keeping, must never equal authorization to adjust or write off. The risk register names what goes wrong and why it matters. The high risks cluster around cost accuracy, landed cost understatement when duties are expensed, outdated standards and a wrong POR that distorts COGM every single period, abnormal spoilage capitalized into inventory, and theft when cycle counts are missing. Untimely, LCNRV overstates profit in interim periods. Medium risks, like job cost sheet errors or stale ABC drivers, distort individual product profitability. Each one ties back to a control you just reviewed. Here is the 5-step advisory method that makes this real for any client. First, understand the inventory type, production flow, and costing system. Second, verify the landed cost policy and that duties and freight are capitalized. Third, assess standard cost accuracy and the overhead absorption rate against recent data. Fourth, review the variance reports and check that significant items are actually investigated. Fifth, reconcile the subledger to the GL and assess LC. NRV steps 3 and 4 are where advisory work beats bookkeeping. The 6 phases are universal, but the emphasis shifts by business. A trader or retailer lives in phases A, E, and F, with landed cost and LCNRV as the main concerns and no variances at all. Batch and process manufacturers run phases B, C, and D fully, with yield variance and equivalent units front and center. Job order manufacturers watch the job cost sheet and open jobs. ABC adopters must keep drivers current, and import-heavy businesses face the most landed cost complexity of all. The case scenarios train your instinct for trouble. Freight and duties expensed signals understated inventory and permanently favorable price variances. A POR built on theoretical capacity creates a chronic unfavorable volume variance and mispriced products. A 15% count shortage with no cycle count means a year of undetected theft or error. Treating all spoilage as normal hides abnormal losses in inventory. And a labor efficiency variance that is never investigated buries the real cause. Each red flag points straight to a corrective action. Let us bring it home. Inventory moves through 6 phases from procurement to COGS, and the costing system you choose, job, process, or ABC, shapes every number along the way. Standard costs and a sound POR keep valuation accurate, while the 9 variances, strong controls, and timely LCNRV protect the balance sheet. The real advisory value lies in investigation, turning variance reports and reconciliations into management insight rather than mere bookkeeping. Thank you for completing the full inventory and cost accounting cycle series.